All right, let's jump straight into this deep dive. We're tackling a really critical topic for pretty much any business owner, business interruption insurance.
Mm-hmm.
This is all based on the material you shared with us, including a great article by Chris Lehnes that really digs into the ups and downs of this coverage.
That's right. Our goal here is, well, to cut through the noise,
Yeah.
figure out exactly what this insurance is designed to do, see how it works in the real world,
Yeah.
both the good and the bad,
Yeah.
and ultimately help you get a clearer picture of whether it makes sense for your specific situation.
Because honestly, when you run a business, the idea of being forced to shut down, even temporarily,
Yeah,
it's terrifying, right?
absolutely.
You still have bills, you still have staff you want to take care of, but the money just stops coming in. Business interruption insurance is often pitched as the safety net for that, a real lifeline.
It is.
But as this material makes clear, it's way more nuanced than just your business closes, they pay you. There are some crucial details we absolutely need to unpack.
Yeah.
So let's start there. What is business interruption insurance? You also hear it called business income insurance, yeah.
Mm-hmm. Business income insurance. That's right.
How is it different from, say, the insurance that covers your building or your equipment?
That's really the core distinction. Think of traditional property insurance as covering the stuff, the building, the inventory, the machinery, if it gets damaged.
Okay, physical things.
Right. Business interruption insurance doesn't cover that physical damage itself. Instead, it steps in to cover the financial consequences when that damage or another specific event forces you to stop operating. It's about replacing the income lost and covering your ongoing expenses during that downtime.
Okay, so it's not the cost of fixing the fire damage in the kitchen. It's the money you didn't make because the kitchen was unusable for 3 months.
Exactly. The material uses that restaurant fire example, and it's perfect. Property insurance pays for rebuilding. Business interruption insurance pays for the fact that you had 0 customers walking through the door for that entire period.
Yeah.
It helps bridge that gap.
Makes sense.
And typically, you'll find this kind of coverage either bundled into a business owner's policy, a BOP, or maybe added as a rider to a commercial property policy.
It's not just replacing lost sales, right?
Yeah.
What else can it cover? You mentioned ongoing expenses.
Yeah, it can cover a whole range of those unavoidable costs that keep piling up even when you're closed. Things like your monthly rent or mortgage payment,
Okay.
payroll maybe, to keep your key employees on staff,
Crucial.
taxes, loan payments, even necessary expenses like temporarily relocating your operations somewhere else if you need to.
Oh, wow.
The payout calculation is usually based on your historical financial performance, sort of to estimate the lost income.
So what triggers this? What kind of events typically qualify?
Well, policies can vary, of course, but common covered perils include things like fire, damage from storms, vandalism, maybe equipment breakdown, certain types of power outages, and this is a key nuance we need to talk about natural disasters, specifically when they cause physical damage to your property.
Okay. Physical damage again.
Exactly. And sometimes even specified cyberattacks are included, though that often requires a special add-on, a rider.
Okay, that list covers a lot, from a rogue vandal to a hurricane, potentially.
It does. But here's perhaps the single most critical takeaway from the material you provided, something that, frankly, surprises a lot of business owners.
Yeah.
For many standard policies, the coverage is only triggered if the disruption is caused by direct physical damage to your insured property from a covered peril.
Wait, hang on. So if there's a massive power grid failure that shuts down the entire city and my business can't open,
Yeah.
but my building wasn't physically damaged by the power failure itself, I might not be covered.
Precisely. That's often the case. Or if a huge fire breaks out 2 blocks away and the police cordon off your entire street, forcing you to close for a week, but your building isn't touched by the fire.
Nothing happened to my property.
Right. That physical damage trigger might mean no coverage. This point alone is huge and really often misunderstood.
Wow. Okay, that shifts the perspective quite a bit.
Yeah.
So understanding what's not covered is just as important as understanding what is. What are the typical exclusions we need to be aware of?
Absolutely vital. Standard exclusions often include big events like earthquakes and floods.
Right, usually need separate policies for those.
Exactly. For those, you typically need to buy specific insurance or add special riders. And this became incredibly clear during the pandemic. Communicable diseases, like COVID-19, are generally excluded from standard policies, unless a specific rider was purchased way beforehand.
That explains so much of the struggle businesses faced during the lockdowns. Makes perfect sense now.
It does. Other common exclusions include those power outages not caused by insured physical damage like the grid failure we just talked about,
Right.
utility failures that happen off your premises, maybe a water main break down the street,
Okay.
government-mandated shutdowns that aren't a direct result of insured damage like, say, public health mandates.
Hmm.
And, of course, losses due to just general poor business management or a lack of market demand.
So if my coffee shop closes because I picked a terrible location and while no one comes, that's not what this insurance is for.
Correct, not at all. It's designed for unexpected external forces disrupting operations, not internal business challenges or market conditions.
Got it.
The biggest point here, and I know we're repeating it, but it can't be stressed enough, is that policy language varies wildly. You have to look at the specific exclusions listed in any policy you consider. Read the fine print.
Okay, so we've looked under the hood, what it is, the mechanics, and those really important triggers and exclusions. Despite those complexities, there are significant upsides, right? What are the main benefits the material highlights?
Yeah, definitely upsides. The most obvious one is income protection. It genuinely helps replace that lost net income and covers those essential ongoing expenses like rent and utilities we mentioned.
Mm-hmm.
For a business with limited cash reserves, maybe only a few weeks buffer, this can be the difference between riding out a crisis and shutting down permanently. It's huge.
And keeping staff paid during downtime, that's a huge benefit listed here as employee retention.
It really is. I mean, imagine having to lay off everyone because you're closed for a couple of months.
Oh, tough.
When you're finally ready to reopen, you're starting from scratch with hiring and training, which is expensive and time-consuming. Being able to keep your core team together provides vital continuity.
Yeah, that makes sense. It also mentions business continuity. How does the insurance help with that beyond just paying bills?
Well, it can help absorb extra expenses needed to minimize the disruption or get back online faster. Maybe you need to set up a temporary location quickly,
Okay.
or rent different equipment,
Yeah.
or outsource a process you normally do in-house. These extra expenses riders, if you have them, can cover those costs, helping you maintain some level of operation and not completely lose market share while you're down.
And the point about loan repayment is a very practical one.
Definitely. Lenders don't typically pause your obligations just because you had a fire or a flood.
No, they usually don't.
So having the income stream or funds from a business interruption claim helps ensure you can continue making those payments, preserving your creditworthiness and, your relationships with your bank.
Finally, there's the big picture benefit. Protection from uncontrollable events.
Yeah, this really speaks to the peace of mind factor. Disasters and unexpected events are, unfortunately, part of the reality of running a business.
True.
Knowing you have a financial plan B in place for those covered events provides a crucial layer of security. It allows you to focus on recovery rather than immediate financial ruin.
Okay, so the potential upside is huge, but as we've hinted, the path to actually realizing those benefits is paved with potential roadblocks. Let's dig into the material highlights. First up, high premium costs.
Yeah, this is a significant barrier for many smaller operations. Premiums aren't cheap. They're calculated based on things like your industry risk. Your location, are you in a hurricane zone or earthquake area? Your total revenue, your claims history.
Right.
For a business on a tight budget, that annual premium can feel like a substantial expense for something they hope they'll never actually need to use.
And the claims process itself sounds complicated.
It often is, which is listed as a major con. Complex claims process. Proving your loss isn't simple. You need extensive, detailed financial documentation to back up your claim.
Ugh, paperwork.
Lots of it. Demonstrating exactly what income was lost and which expenses were necessary and covered. This complexity frequently means you need to bring in forensic accountants or even lawyers to navigate the process.
Adding more cost.
Exactly. Adding further costs and prolonging the whole thing during an already incredibly stressful time.
Which brings us back to something we already stressed, limited coverage scope.
Exactly. We can't emphasize this enough because it's where so many business owners get, disappointed. The perception might be, my business is interrupted, I'm covered. The reality for many standard policies is more like, my business is interrupted because of physical damage from a covered peril that happened on my property. Now I might be covered.
That distinction is everything.
It really is. Disruptions without that physical trigger are very often excluded.
There's also the issue of waiting periods. What's that about?
Yes, most policies have a kind of deductible, but it's in terms of time, not money. There's typically a waiting period, often maybe 48 or 72 hours, from the moment the disruption starts until the coverage actually kicks in.
Oh.
So if your business is only forced to close for a day or two, You likely won't receive any compensation for that brief loss of income or expenses.
And finally, the exclusions that became so relevant recently, exclusions in pandemics and civil unrest.
Right. The COVID-19 pandemic starkly showed how widespread the exclusion of communicable diseases is in standard policies. It was a shock for many.
I bet.
Similarly, disruptions caused by civil unrest, curfews, or government orders related to those kinds of events are often excluded unless specifically added back with riders, which can be expensive or hard to get.
It seems like the relevance of all these points, the pros, the cons, the triggers, also depends heavily on what kind of business you run. The material points out some important industry-specific considerations.
Absolutely. The risks are totally different. A retailer, for example, relying heavily on foot traffic and carrying physical inventory, is incredibly vulnerable to physical damage or loss of access. A fire or flood is just devastating.
Makes sense.
A food and beverage business faces high risks from fires, equipment failure, spoilage, health-related shutdowns. Lots of vulnerabilities there.
Whereas a tech or SaaS company might have minimal physical risk, but be critically exposed to cyber attacks or server outages, right?
Precisely. And standard BI policies aren't always designed for those specific digital risks without special cyber coverage writers. You have to look carefully.
And manufacturing.
They might be more concerned with critical equipment breakdown or disruptions to their supply chain, which again needs careful policy consideration to see if that's even covered. The type of business you operate significantly impacts the specific perils you need covered and, just as importantly, the exclusions you need to watch out for.
To make this feel less theoretical, the material shares some case studies showing how this plays out in the real world. That's always helpful.
Yeah, these examples really hit home. You have the positive story, like the family-owned bakery. A severe fire closed them for 5 months.
No, 5 months.
Yeah, a long time. But because they had good BI insurance, they were able to keep paying their key staff. They set up a temporary location to keep some revenue coming in. And crucially, they stayed afloat financially until they could rebuild and reopen.
So the insurance worked as intended.
Exactly. A
Yeah.
genuine lifeline in that case.
But then there are the stories that highlight the limitations, the disappointments.
Yes, like the thousands of businesses denied claims during COVID-19 because their policies specifically excluded communicable diseases.
We talked about that.
Yeah, and the example of the Chicago restaurant that sued their insurer and lost really underscores the power of those exclusion clauses in the contract. Even a devastating loss might not be covered if the specific cause is listed as an exclusion.
And the Houston retailer who got nothing after a flood.
That's another classic, unfortunately common example. They were shut down for 2 months, a massive loss of income. But flood damage was explicitly excluded from their standard policy.
And they didn't have separate flood insurance.
Exactly, they hadn't purchased it separately. These examples aren't just statistics. They're painful lessons highlighting the absolute necessity of understanding the policy details, especially those exclusions and trigger mechanisms.
So with all these pros, cons, complexities, and these real-world examples, how does a business owner even begin to figure out if this insurance is right for them? The material provides some really practical questions to ask yourself.
Yeah, these are kind of the gut checks, aren't they? Like, can your business honestly survive if you had zero income coming in for 1, 2, or even 3 months?
Sobering question.
It is. And how heavily does your revenue depend on your physical location being open or having physical inventory available right there?
Do you already have a detailed plan for what you would actually do if a disaster struck, like a business continuity or recovery plan? Is it written down?
Good point. And are you located in an area known for specific risks, like hurricanes, tornadoes, wildfires, maybe even higher crime rates that could lead to vandalism?
And importantly, do you have readily available access to emergency funding, like a significant line of credit you could draw upon if needed quickly?
Exactly. The material suggests, and I think it's right, that if you find yourself answering no to several of these questions, it's a strong signal that you need to take a very hard look at business interruption coverage. It might be more necessary than you thought.
Okay. If someone decides it is something they need, or at least need to explore seriously, how should they go about choosing the right policy? It sounds like they aren't all the same at all.
They are definitely not created equal. First, go back to that risk assessment. Based on your specific business, what are the most likely scenarios that could realistically shut you down?
Okay.
Then, you got to get into the weeds of the policy options.
Okay.
Understand the difference between named perils policies.
Which only cover specifically listed events.
Right. Versus all risk policies, which cover everything unless it's specifically excluded. Generally broader, but they still have exclusions you need to read.
And look at options like extra expenses coverage, which we mentioned helps with those costs needed to keep things going in some form, like a temp location.
Yes, absolutely look for that. And crucially, explore those optional riders we talked about for things like cyber risks, maybe civil unrest, or even pandemic coverage if those are significant concerns for your type of business and location.
Right.
And pay close attention to the duration limits. How long will the policy actually pay out for? 6 months, a year. And the overall benefit caps what's the maximum dollar amount they will pay for a single event.
It seems like trying to figure all this out alone, navigating the jargon and the options, might be a bad idea.
Yeah, I'd strongly recommend working with a professional. Find a knowledgeable insurance agent or broker, ideally one who specializes in commercial policies, maybe even in your specific industry.
Okay.
They can help you navigate the options, really understand that fine print, and hopefully tailor a policy that actually addresses your specific risks, not just some generic template.
And review it regularly.
Oh, definitely. Don't just set it and forget it. Review your coverage regularly, at least annually, especially as your business changes or grows. Your needs will evolve.
Okay, but what if, after going through all this, it seems like business interruption insurance just isn't the right fit? Maybe the cost is just too high for a small business, or the exclusions mean it wouldn't cover the risks they're most worried about. Are there alternative ways to build resilience?
Yeah, absolutely. Insurance isn't the only answer. The material does offer some other strategies. One really fundamental step is building up a solid emergency savings fund.
Just cash reserves.
Yeah. Aiming for enough cash reserves to cover, say, 3 to 6 months of essential operating expenses provides a crucial buffer. It gives you options.
That takes discipline, but gives you flexibility, like you said.
It does. Another avenue, particularly after a widespread regional disaster, is looking into SBA disaster loans. The Small Business Administration often offers low-interest loans specifically designed to help qualified businesses recover after a federally declared disaster.
Worth knowing about.
Definitely. Maintaining an open line of credit is also mentioned.
Like with your bank?
Yeah, having pre-approved access to funds you can quickly tap into provides that emergency cash flow. It can help cover expenses during an unexpected downturn or closure, bridging a short-term gap.
Okay.
And finally, for larger, more financially robust companies, self-insuring is potentially an option. That basically means they have sufficient internal capital, big reserves, to absorb potential losses themselves without needing external insurance coverage. But that's usually for bigger players.
Right. Not for most small businesses. So summing it all up, it sounds like business interruption insurance is powerful in theory, maybe essential for some, but the devil is really, really in those policy details and exclusions.
That's the core message, absolutely. It's definitely not a one-size-fits-all solution. For businesses in high-risk locations or industries, or those heavily reliant on a physical presence and prone to physical damage, it can absolutely be that crucial lifeline during a crisis.
Yeah.
But the cost, the complexity of making a claim, and those often surprising exclusions like that physical damage trigger we keep coming back to, or the communicable disease exclusions, those can be significant barriers or make it less effective for other types of risks or businesses.
Ultimately, the decision comes down to your specific business's tolerance for risk, right? And the amount of cash you have on hand to weather a storm, and how fundamentally reliant your operations are on being physically uninterrupted.
Exactly. It's a very individual calculation. And perhaps, the most valuable insight from digging into this material, regardless of whether you ever buy a policy or not, is this.
Okay. Consider whether the very process of creating a detailed business continuity plan, of actually sitting down, honestly assessing your most vulnerable points, figuring out exactly what would happen financially if you had to close for a period, and calculating the cash you'd need might be just as eliminating, just as valuable as the insurance itself.
Huh. Interesting thought.
It forces you to truly understand and prepare for the unexpected challenges your business could face. It makes you confront those vulnerabilities head-on, policy or no policy.